What's going on, everybody, and welcome back to another episode of the Get Over Yourself podcast, where today I'm joined by Sean Tepper. Sean is a visionary when it comes to investing, and in today's episode, he's going to be sharing a little bit about his business Tykr and why it's important for young and honestly naive people to start investing early and how we can begin to do so. If you're a beginner investor or even a seasoned pro, this episode will be for you. With that being said, I do have a couple technical difficulties today. Sean has been more than patient. We're currently 20 minutes behind on recording because the microphones and everything else just don't always tend to play nice with us. So Sean, he's also a patient man, and we appreciate that with him today. But he's also calling in from Milwaukee. We're excited to see where he's, what kind of information he's got for us. Sean, are you a Brewers fan by chance?
Brewers, Packers, Bucks. You
Okay.
got the usual suspects here in the Milwaukee, Wisconsin area. Yeah.
Heck yeah. I love it. I love it.
Yeah.
Yeah, I'm a Dodger fan myself, having grown up in Southern California, but I've always
Yes.
respected the Brewers. You guys are the team that somehow always gets first place, and then just like the Dodgers, get first round exited. So I feel your pain, man. I feel your pain.
Yep. Sounds about right.
Yeah. Well, guys, be super excited. Today's episode is going to be quite unique. We're going to talk about the early days of Tykr, Sean's company here, how it got started, how he got his first customers, as well as his investment strategies. If you're a beginner, you don't really know where to begin investing your funds, this episode, once again, is for you. So with that all being said, let's jump into it. Sean, thanks for joining us, man. I appreciate it.
Brandon, thanks a lot for the invite. This will be fun.
Yeah. So you're calling in from Milwaukee. Tell us a little bit about your family life, and just a couple of your hobbies before we jump into the full meat of the conversation.
You got it. Yeah, I grew up just north of Milwaukee, small town nobody's heard of called West Bend, and I actually grew up just middle class. You know, both parents did a wonderful job raising my sister and I. We actually were very involved in sports. We both kind of leaned into swimming, competitive swimming. As we speak, the Olympics are going on, so I'm like glued to the TV to see how the U.S. is performing.
Oh yeah, you gotta be glued during the Olympics.
Oh
You gotta.
man, like it's cool to see the performance. Although that we could go down a rabbit hole. Times have been slow. They made the pool 6 feet deep as opposed to 9 feet deep. And that's critical for the motion of the waves as they come into the wall. They move down. Also issues, I don't know if you paid attention to, like the lack of food, the sleeping on cardboard
Oh, the beds.
beds.
Yeah, that's been like the highlight of everyone. These cardboard beds. It's very interesting.
Paris. Yeah,
They're trying to
I'm
do
not
it
going to
cheap,
hold my
man.
tongue. You have failed with flying colors. Like never
They're they're,
again.
they're the only Olympics who have come out with like not incredibly in debt because of it. And honestly, I guess good for them on a business standpoint. Good for them, but it's not making them look too hot.
Oh my God. Their athletes are in pain. They're struggling. Swimming, get this, like 100, again, we could go down a rabbit hole. 100 breast, world record is like a 57.2. Gold medal one with like a 59.0. And now that doesn't sound like a big difference, but in a 100-meter breast or
Oh,
100-meter any event,
those
that's like
seconds,
a
those
mile.
milliseconds. Yeah,
Right? It's like people looked at the clock like, the math isn't mathing here. So, and
yeah.
that's just event after event after event. So, anyway.
Well, yeah, that's awesome. I'm glad to see we got another Olympics fan. I used to do swim back in high school a long time ago,
Okay, sure.
but
Yeah,
yeah, definitely know what we're talking about here. I want to start and jump straight into Tykr. That's what we want to talk
yeah,
about on the bulk of the episode today. Like you said, you grew up in a small town in Milwaukee. Or I guess a little north of Milwaukee, but
sure.
what on earth got you interested in starting your own business? Tell us a little bit about your early days getting started. What
Yeah.
did it take? I'm sure you had a lot of hardship and failure, and yeah.
Good question. I'll try not to spend too much time here, but I was one of those kids that I really leaned into sports, but I hated school. School was extremely boring. The concept of like sitting down, staring forward, being obedient, and that method of learning doesn't work for me. And I always thought I was a little weird until later in life I started to meet more people like myself that are like hate school. Except when I was in school, there was one class. It was computer aided design where the teacher didn't teach, and I loved that. He would literally come in with his laptop, ESPN queued up, and he'd give us a book. He's like, "You learn at your own speed, and if you have questions, you come to me." And then he'd look at ESPN all class, and I loved it because that's how I learn. I learn at my speed. I don't want to sit and be patient and wait. So I would dive into the books. get done with the assignments within like 15 minutes and have the rest of the time to play on the computer or help other people in the class. And I'm like, this is cool. I want to do something with computers. So I decided to pursue architecture. Got into architecture school, UW Milwaukee, which in the Midwest, for context, the two big architecture schools of U of M, Minnesota, and then UW Milwaukee. And the problem with getting an architecture school, it was all focused on model building and drawing, which I figured out pretty quick I'm horrible at. There are no computer classes. And I'm like, this is stupid. So I did that for a year and switched to fine arts and emphasis on film. I was thinking, hey, going into the movie industry or the TV industry, cinematography, screenplay writing, got a degree in that, but didn't go to the East or West Coast. I decided to stay local and get another alternative there is to find careers in advertising or marketing. So I went to work for a marketing firm for 1 year, but this really was my journey of like entrepreneurship is I call it being an ethical spy. Get into a business and learn how the business, how do they negotiate? How do they sell? How much do they charge? What do contracts look like? And I did that for a year, just learning everything I could because I'm like, I'm going to create my own agency after year one. So I did that, built that business, created my own business, between 2006 and 2010. Didn't make like any money for myself. We were growing, but adding
That's a
people.
hard time to be starting a business there.
Recession, great choice, Sean. Good choice, But the benefit was, and I didn't realize this till after the fact, was I analyzed about 400 different businesses, served about 100. So closing ratio of about 25%. But I knew after 4 years what was like a scalable business, what's ideal. And I really discovered SaaS. SaaS is like top of the food chain. Also up there is like payment tech, ad tech, list goes on. And we went through a merger in 2010. It wasn't like a big check was written at that point. It was like all debts and liabilities wiped clean. But I knew like, all right, I want to create a SaaS business, but I didn't have any good ideas. I was looking at like, MailChimp, Salesforce, even Netflix. I'm like, I want to do something like that. So path of least resistance, started doing corporate contracting for public companies, planned to do that for 2 years. That turned into over 10 years. But in parallel to that, I got into investing. Now I started the hard way. I started investing in private companies, which is angel investing. Made some money, lost some money over 5 years. 2015 came around. I'm like, let's do this smart. Let's take a step back and follow Warren Buffett. So I started creating an Excel sheet. And thanks to Warren Buffett, Charlie Munger, and Phil Town, I was able to put the calculations into Excel. Then over the next 4 years, I made returns in the market between like 15 and 50%. So it's definitely beating the market by a lot. Again, credit goes to those guys, not to me. I just kind of put it all together. And I wanted to create think of it like a traffic light rating system, like a green light, red light. Is it a good stock or bad stock? Because nobody's doing that. 2019 comes around, I start sharing this Excel sheet with a few people, and they're like, you know what, you should turn this into a SaaS business. And I was like, now we've got a SaaS idea 10 years later. Took a year to build the first version of Tykr. Then it took 6 months to get the first paying customer, which is very humbling in itself. But I've been building software a long time by now. You just want to get feedback fast, and then turn it around and deliver to the customer. And now we've been live 4 years. We just crossed 10,000 customers this week. And we're really proud of this. We've got a trust index, also on Trustpilot as well, trust index score of 4.9 out of 5. We place a really high priority on customer service. A lot of businesses fail in that department, but I said, we're going to treat our customers with the absolute most respect we can. And yeah, so far it's going great.
Heck yeah. Sean, first and foremost, congratulations on the 10,000. That is absolutely amazing. Very, very few businesses can actually reach to those metrics. So congrats first and
Thank you.
foremost. Yeah. So tell us a little bit. Who is your ideal audience? Like you
Yep.
said, you made this spreadsheet. You showed it to a couple people, and eventually they said, "Hey, this is what you should turn your business into. This is super helpful for us. You could turn this into something."
Yep.
So how did you take their original feedback? Were they friends and family? So were you afraid they were just kind of leading you on, saying, "Oh, this is a great idea, Sean. Good luck." What actually got you started on working on Tykr, where you knew it wasn't just somebody saying, "Good job for what you're working on," but turning
Yep.
it into an actual business?
I 10 years ago I made the mistake of asking people in my friend circle like what they think, and there's a book out there that touches on this called the mom test. You probably read. Yeah. If you go to your mom and say, "Hey, is this a good idea?" What is your mom going to tell you? She's
Of
like, "Yeah,
course,
it's a
it's a great idea.
great
Yes.
idea." Yeah. So I immediately started talking to people that are retail investors. So Ticker right now is a B2C play. We serve the retail investor. So I knew at that point, let's talk to some of my friends or acquaintances that I know buy and sell stocks, and whether it's TD Ameritrade or E-Trade. I know what they're doing in parallel to what I'm doing. And I went to them immediately. Like, what do you think of this? And got their feedback right away. So you go right to the market. So I did that. And then with the business, I knew building software, like, yes, solving my problem is one thing, but that's not how you really make money. You have to be in product owner mode and get feedback really fast from your customers. And that's literally what I did on day one is, and so, like the first 100 people on the platform were free. I want you on the platform and I want you using it, but in return, I want feedback really fast. Like, why does this suck? What would you do better? And don't hold back. Like, gloves off, punch me in the face, say, Sean, you got to do this, this, and this better. I want to know right away because I don't want to go years playing games. And I did that. And that's how we were able to build a product to eventually get our first paying customers. And then eventually, over the next few years, it took a while to get product market fit. I could talk about how do you quantify that. But that was the process from the beginning. Get it in the customer's hands really fast and get free customers on the platform. Don't worry about making money. That will come. You got to get people using it.
That's an interesting take. I've heard both sides of this argument, where on one side it's get as many people as you can possible, get their feedback, innovate it super quick, fix all the issues that they have, and then push it back out. On the flip side of that, I've heard you should go out and charge your early customers because that's how you
Hmm.
initially get feedback of this is something that somebody is actually willing to pay for. What's your take on that? Why would you suggest your way over the other?
Well, I've tried building software that way, and when you try to charge people when you don't have product market fit or even a product that really solves a problem, you're putting the cart before the horse. And there's going to be friction there. There's conversations in play about how much you charge and why am I charging and how is get rid of all that. Get rid of all the noise and just get their hands on the product. Don't worry about them. And what happens then is they're in the platform, guess what they're going to do? If it starts getting better, they're going to start sharing it with their friends. And that's when you start making money. So when you start charging right away, you're limiting your potential. Get people on for free because if you're good at your job, those people are going to share the tool with others. It's a magnified effect.
Definitely. And jumping into this a little bit more now, where did you find your first initial, even though they were free at the time, they were still customers, they were still giving
Yep.
you feedback, they were still helping you ideate and make your product better. Where did you go to convince these original 100 guests to join the app and start giving you feedback? Because at the same time, yeah, you might not be charging them 5 to 50 to 100 or whatever you charge for your platform nowadays, but you still are asking them something even more important than money, which is their time. Will you provide me your time with feedback in order or in exchange for using this for free?
Yep.
So how did you find those initial 100 people? Were they all superstars who kept giving you constant feedback? Did you have to kind of like hone in on them a little bit more? How did that process work?
So right away, I talked to about 5 to 10 friends, and then I'd ask those friends, this is sales 101, especially if you're in a service business. Do you know anybody else that you feel would be interested? Simple question. And that kind of starts the domino effect of getting more people on the platform. I have to be honest, I aimed for 100. I did not get 100, just 'cause that's a lot of people to manage. I probably got between 40 and 50. I told myself I'm going to get 100. That was my goal. 40 to 50 was enough to like put us on the straight and narrow so we know what we're doing. But it's really just ask that question, like, who else do you know that may be interested in using this? I want to bring them on for free, but in return, I want feedback. And of course, the guys like around our age are like, oh, yeah, I'll talk to my buddy Mike or my buddy Jim or, whatever, and the word travels fast.
And were these original 40 to 50 people, like you mentioned, are these people who were kind of somewhat interested in investing, just didn't know where to start? Were they, I have no idea what investing is. I have 500 bucks sitting in my bank account. I don't know how to save money whatsoever. I
Mm-hmm.
guess what group of people were you targeting? Or at the beginning days, were you targeting everyone to see who actually stuck around?
These were people that were already retail investors that are buying and selling stocks on their own. Now, to the degree of how skilled they were, that was in question. Some were like Yeah, I usually, buy on emotion, and they've been doing that the last few years. And there was like one or two that use another stock analysis platform, like a Seeking Alpha or Simply Wall Street. We will always say good things about our competitors, and those are two good screeners. And it's like, okay, well, have a look at Ticker and let me know what you think. So it's really over the board. To give you context on where we're at today, about 80% of our audience are complete beginners. So it's somebody hearing something from a friend at a party or a gathering or whatever, or on YouTube or X or Reddit. And then they go join a broker like a Robinhood or a Schwab. I use Schwab. There's Fidelity. The list goes on. And then they have no idea what to do. And so we serve that 80%. The 20% are like people, they know what like market cap means. They know what PD ratio means. And they just use Ticker because Ticker's analysis and the UI, UX, it's very clean. They can get from A to Z much faster, like get an answer much faster than any other platform out there. So it's a big time saver for that 20%. But most people are beginners, and that's where we really lean into.
And with all these beginners, do they ever feel like when they start using your software, Ticker, do they ever feel chaotic? Do they give up? Do you guys have any information on kind of the churn rate? Because investing is very scary for your average person.
Yeah,
Like even for somebody like me, I don't consider myself a seasoned pro in investing whatsoever. I dabble in it, I play around with it 2 to 3 times per week, but I'm not like a daily sitting there constantly looking at it. Investing for me is even scary sometimes. You don't know
sure.
exactly what's going to happen. So how do most of your early customers feel right when they join Ticker?
Yeah, so a lot of people like our onboarding. One thing, and I give a lot of credit to a company I worked for in the past, which is Kohler, and they really emphasize the fact you want to provide a gracious experience for your customers from A to Z. And I was like, yes, like nailed it. So with Ticker, it's the same thing. Like when you join, you get a very welcoming email. You get a video for me, like, hey, thanks for joining, really appreciate it.
I
And
noticed that
then
on your website too. You even have a little video on your website of
yep,
yourself.
in the lower left there if you're on desktop. And what the purpose is then is people, of course, will think of investing and they'll think about, okay, making money, getting rich, building wealth. And that's all cute. But the one word people care about more than anything, we A/B test this over the nth degree over the last few years. That one word is confidence. So we really lean into that. We just want to help you get confident with investing. So that's why each email, like you get that welcome email, and then we send you a new email, like a new educational tip the next 20 days. Like every day it's a new tip, and you can read them all in one go because it's all on our blog. But that way, things like when to buy, when do you sell, how to reduce risk, how to invest your first $1,000, how many stocks should you hold, what should you do about penny stocks. All really basic stuff written in simple terms. There's no like $20 finance words out there, you know? And people like beginners are like going from like beginner to expert, and we're talking 30 days or less. In fact, we did a survey asking customers like, hey, after joining Ticker, how many of you were able to confidently buy or sell your first stock within 30 days? And I have to, this was surprising. The number came back as 100%. Now we don't advertise that, but it's like, we'll say 99%, what it,
Sometimes you put the actual number, people don't believe it, right?
yeah, exactly. And there's the old saying, I'm a movie nerd, only the Sith speak in absolutes. So it's like, it's not an absolute 100 or zero. It's like go 99, but it's like, okay, like we're doing good there. You mentioned churn. This was really big, and this took years to achieve, which is when Ticker went live, we had certain features, but we needed to add more features to really get us from product market fit to product maturity. What I mean by that is you could buy a car, but if the car doesn't have heating, air conditioning, or four wheels, it's still technically a car, but is it really product maturity? The answer is no. Well, we needed to add a ton of more data points, portfolio tracker, a bunch of features to really get us to the point of like we got a legitimate product. And we also had to play with our pricing. That was a journey in itself. Finding pricing with SaaS can be very hard. And I give thanks to a guy by the name of Jason Cohen. He's got a TED talk on this, but he talked about if you can move your base plan to $99 a year, something magical happens. And we were at like $199 first year, and our monthly price was $29.99. I was like, he's onto something. So we moved our price to $15 a month or $99 a year, which is about a 30% reduction for the yearly option. And by getting to product maturity and reducing our pricing, our monthly churn went from about 11% in 2022 to less than 5% in 23. And for context, if you can get to 5.75% or less monthly churn, you've got yourself product market fit. And we consistently over the last year now, we're at like some months it's 2%, some months it's 4%. There were 1 or 2 months it was 0. But it's like, okay, product market fit achieved. It's tough to get there, but it's playing with pricing and getting your product to product maturity to get you to that level. And it just takes time. It took about 3 years to get there.
I appreciate you mentioning that too. A lot of entrepreneurs that I have on this show sometimes get on and hype themselves up. 0% churn. This was an easy process to get started. Our business is just rolling
No,
and rolling. That's not the truth of the matter. Every business has
no.
these exact same issues. So tell us a little bit. You obviously have kind of cracked that for me a little bit more. You lowered your prices. That's also against the traditional norm for a lot of businesses. I think the only other company where I've heard that, at least recently in the top of my head, is Ryan Reynolds Phone Company. Whenever I listen to podcasts, I always get that.
Yes.
We're,
Yeah.
we're lowering our, everyone is raising their prices. So we decided to cut our bill in half. Now join for $15 a month or whatever it is.
Because we don't hate you.
Yeah, because we don't hate you. Yeah, it's a good advertisement because I'm like, even though I'm locked in with my phone right now, I'm like, man, that's something I want to keep in mind because I would like a lower phone bill, and if it works just as good. So, what kind of effect did that
Yeah.
have on your customer standpoint? Obviously, you talked about churn, but did that help you increase your customer count as well when you lowered prices? Albeit not
Yep.
by that much, but enough.
Yes. So let me give you context there. We had one pricing plan from the go. And for context, I had some people at the company. I'm 100% owner, and I did bring people on for my minority share to help fill other roles in the C suite. I make it sound like we're a huge company. We're not. 10 people or less. And there were decisions being made that were not advantageous for growth of the company. Having one pricing tier is a mistake. Like if you're a SaaS, but they were saying like Headspace is a great platform. They have one pricing tier because it reduces decision fatigue. Well, when you're a business that has a lot of different features and some features are powered by third-party companies, you need to have different tiers. So this is summer of 23. Those other people were removed from the company. I'm now 100% owner again, and I decided I'm making the calls and we're going to take this in the correct direction. So we created 3 tiers: premium, premium plus, and advanced. Premium, yes, did drop in price, but premium plus is $49 a month or $200 a year, which is a bit more than other competitors out there for their middle plan. And then the advanced plan that's $200 a month or $1,500 a year. And of course, you have to justify it. You got to have the right features packed into those. But it was a methodical process, and our customers, we got very little feedback. Now, there were a few that said, "Hey, why are the prices increased?" But you got to sell it. You got to sell the why. You can't just be timid, and you can't apologize, right? That's a bad mistake. So you commit to it. But another thing is, you had to really, or I had to think long term and think about how do I put pricing in place so I don't have to keep dialing up pricing every year. Like we're so rock solid on our pricing, we could probably go without upgrading prices or increasing over the next 3 years. So it's a good spot to be in. But in any SaaS founders out there, you want 3 tiers for sure because you don't know where your business is going to go. Third-party features can cause problems to profit margins. So you can throw certain features into certain tiers of your pricing and you'll be okay. So that was hard. That was a really hard process to,
And it obviously takes time to kind of
yeah,
figure it out, and you play around with it, switch up pricing all the time. But
yeah,
eventually, once it sticks, that's been a game
yeah,
changer in your business. It sounds like.
yeah, yeah, for
So
sure.
let's jump over now from the individual investor standpoint. Tell us some early tips if you're just getting started into investing. What are some things you should be looking for? What are some piece of
Sure.
advice that you have for somebody who's just getting started?
Yeah, so you guys will love this. So if anybody out there, you got a friend, you're at a holiday party, summer parties going on as we record, and somebody tells you to buy a stock, the last thing you should do is buy that stock. The first thing you should do is ask why, and then you be silent and wait for them to provide an answer. In most cases, they're not going to have a wise answer. So
It's because they heard it on the podcast this morning. That's why.
Yeah,
That's the
yeah.
reason.
This person over here, this analyst who's been working at CNBC for 3 months and is just, right out of school. It's what we do. And for context here, Tykr is open source. What that means is the calculations are transparent. You can, and we tell our customers is you can take the calculations and go create your own version of Tykr. We do not care. We want you buying and selling with confidence. And by doing that, by playing that card, people are like, oh, okay, there's no secret sauce. There's no magic formula. You're not hiding behind the scenes. Got it. That sets us apart from everybody else out there. Then what we do is we say, okay, this is basic stuff. You're a business owner, Brandon. You get it. You're going to get the numbers we look at. So Tykr has a scoring system from 0 to 100. Higher the score, the safer in the investment. There's a few other things you can look at, but we look at revenue. We look at profits, which is net income on your income statement. We also look at EPS. EPS, the number one most important line large financial institutions look for. We also look at debt. We look at free cash. All these things make sense to most people. We want to see those numbers increasing over the last 4 or 5 years, depending on how much data we can get. And when we lay things out like that, people are like, oh gosh, it's not that complicated. So it's like you could literally, and we teach customers this too, you can do it manually. You can go to Yahoo Finance, look at the financial statements and see year over year, are the profits increasing or decreasing? If they're increasing, guess what happens? The share price typically goes up. If profits are decreasing, guess what happens? Profits go down. A lot of people out there, even people in Wall Street, they will provide a lot of overanalyzed $20 words in analysis that is complete fluff. It's complete garbage. Now, it's not all of them, but I hear people say, like somebody came at me, one of my customers said, my friend told me I should really pay attention to the Schiller PDE. And I'm like, I told him this and he laughed at this. I'm like, it's that moment in Moneyball when you got all the old timers saying, how they would pick baseball players, like, oh, it really pops off the bat, the sound, or this guy over here's got a pretty girlfriend and this guy doesn't. So that's and Brad Pitt is doing this with his hands, blah blah blah, and he looks at Jonah Hill's character, who's the analyst, and it comes down to getting on base. Well, in our world in investing, are the profits increasing? That's it. That is it. It's not complicated. Sorry, long answer there.
No, I love that example. Big fan of Moneyball as well.
Right.
Although the A's have struggled, it worked well for him for a little bit.
I
Now it's kind of
I
caught on,
know
so it doesn't work
everybody
the same.
figured out the formula.
But still, maybe they'll do that with Ticker too, and we'll all just become millionaires just because of you. So I appreciate that, Sean.
Yeah.
So tell us, are you more into the theory of buying and selling every single day, constant day trading, even for beginners, or you hold long, wait for the right time, drop it then?
So you guys would love our onboarding because it answers a lot of these questions. So right away, we do one of our first articles or one of the first emails you get is the difference between investing and trading. So I'll give the examples here. You'll appreciate this. So investing is where money is working for you, whereas trading, you are still working for money. You are trading your time for a paycheck. And get this, statistically speaking, 99% of traders lose money because you're trying to time your entry and exit. It's a complete waste of time. And another fun fact here is we lay this out in our email as well. There are about 3,000 billionaires in the world. Now, my question for you is how many of those billionaires are traders and how many of those billionaires are investors?
I'm gonna throw this out there just because of the way you said it. I'm gonna say less than 1%.
You're very close. 0%
Oh, there we go. There we go.
traders. And the majority of the billionaires in the world are either entrepreneurs, stock investors, or real estate investors. It's like, oh, okay, so you want to get money working for you. Well, we are focused on what's called value investing. You buy strong businesses, and we talk about the tactics and Tykr. What you want to do is every month try to invest between 15 and 30% of your paycheck. If you can't get that high, that's okay. Start small, start like $100 and work your way out. But then you want to be invested in about 10 to 15 stocks. One of my favorite, you're going to love this. One of my favorite case studies, and we share this with our audience, is a guy by the name of Ronald Reed. You can Google him. He's got an article on CNBC, but the guy's a janitor who built up a portfolio of $8 million. So the question is, how does somebody who's making close to minimum wage become a multimillionaire? The answer, you want to own between 10 and 15 stocks, and you want to keep buying every single month. Do not skip a month. If the market is going down, you want to even buy more. But when times are tough and people are fearful, guess what he did? He just kept buying more. This guy, This guy came out of World War II when times were really tough. Like he, probably experienced the tail end of the Great Depression. Nowadays, if people don't have enough Instagram followers, they have a bad day. It's like you're not having a bad day. Like Ronald Reed went, so he had emotional intelligence to be like, this is just another Tuesday. I'm going to keep buying more. And he was holding stocks like GE, Johnson and Johnson. See, these are not glamorous penny stocks. It's just businesses with multiple revenue streams and strong balance sheets. And that's how you build your wealth. You get your money working for you. So we teach our audience, if a guy that is making close to minimum wage can do this, like you can do it too. You got the right tool now, Tykr, but it's that mindset thing that's really in your control. What can you do? And we try to coach people with our training, and we got educational modules in the tool and all that good stuff. But some people, you and I know this, some people just don't have the emotional intelligence. They'll let something upset their day, and then they're going to buy the wrong stock or sell at the wrong time and lose money.
Right. Right. What's your theory on the difference between just individual stock investments versus an index fund?
Yeah. Yep, we break this down too. So you're in either wealth building mode or wealth protection mode. Wealth building mode is like when you're still working, you've got a timeline to achieve retirement or financial independence. Could be 5 years, could be 10 years, 15 years. In that case, you want to be in individual stocks. Now, if you're in wealth protection mode, let's say you sold a business, you sold some real estate, or you inherited capital from a loved one, in that case, you want to be moving your stocks to index funds, ETFs, or mutual funds, which are essentially a bundle of stocks. Now, unfortunately, there are too many people out there that are, let's say, they're in their 20s, 30s, and even 40s, and they're putting their money into index funds and ETFs. And the analogy, you get the gist here. I do use analogies a lot. The analogy is you're showing up at the Indy 500 with a 1995 Dodge Neon. Everybody else is going 230 miles an hour, and you're going to max out at like 110. Like you got the wrong tool for the job. That's essentially what index funds and ETFs are. They're not building your wealth fast enough. You got to do the Warren Buffett thing, the Ronald Reed thing, the Charlie Munger thing, individual stocks, strong businesses, because that's when you get those bigger returns. Market returns about 8% a year. You can do better. Phil Town, he teaches 15% or more. In my case, I was just a beginner with an Excel sheet making between 15 and 50% with not a lot of effort. And my returns continue in that range. That's when you build your wealth. But yeah, again, too many people, they're like, I'm going all in on my index fund and I'm 27 years old. It's like, heck, what are you doing?
That's awesome, Sean. Hey, I appreciate all the advice you've dropped today. I appreciate you mentioning Tykr. It sounds like it's an amazing business and it's going places. What's your long-term plan for it? Are you planning on selling it off in the future? Is this your forever job? Tell us a little bit more about your exit strategy.
Um, for a while, I was balancing between like, do I raise venture capital or don't I? And I am completely in mode now. Let's continue bootstrapping. I need
Love it.
to be calling the shots. I'm not a control freak, but I've been there down the road with the wrong people in the business. It's like I gotta serve the customer and I gotta do this right. So this could be a forever job. However, if somebody were to buy us out, I would look at like a Motley Fool or maybe a broker like Fidelity. You need to retain the platform in its current state. Whereas if you were to sell to a PDE company or a hedge fund, guess what they're going to do? They're just going to strip it for parts and close it up, and then you can go through our service division to get access to the tool. My customers begged me, don't ever do that, so I'm not going to do that. So right now, to be honest with you, I love building this company. I'm having a blast every day, so no plans to sell it anytime soon.
I love it. I like the sound of that. There's too many people nowadays, and this is fine. I've had plenty of entrepreneurs on before where their goal is to build it up and sell it off. Heck, that's a strategy we're taking with Interval here. But at the end of the day, I love when somebody is super passionate about what they're working on and not afraid to share that with their audience. So thank you, Sean. As we're closing out on today's episode of the Get Over Yourself podcast, if the entire world could hear you in this very moment, what one piece of advice would you share with them, and why would that be?
I'll give you two answers there. One answer on the investing side. If you think that investing is too complicated, too confusing, too time consuming, don't worry about it. Again, 80% of our audience are complete beginners. First place to start, I'm biased. You can start with Tykr, 14-day free trial. Get in, learn how to invest. Alternative to that, you could go to Simply Wall Street or Seeking Alpha, our great competitors, give them a test drive. But if you can do this on your own, it's a lot easier than you think. And then on the entrepreneur side, if you want to build a business, All it does is take time. I heard the saying, and I heard this over and over, is businesses don't fail, people quit. So if you really want it, put in the work day after day and listen to your customers, because if you listen to your customers, don't give up, you can't fail. Those two things are key. Listen to the customers and don't give up.
Perfect. Well, thank you, Sean. Where can people go to find you and Tykr if they want to reach out with any more information or sign up themselves?
Yeah, two answers there as well. First location would be Tykr. Just go tykr.com, and then LinkedIn. I'm very active on LinkedIn.
Perfect. Well, Sean, I appreciate you for joining us on today's episode of the Get Over Yourself podcast. Everyone who's listening, make sure to go check Sean out on LinkedIn or go sign up for Tykr at tykr.com. And if you enjoyed today's conversation, maybe you know somebody who needs to hear these words. Share it with a friend. That's how I continue to grow this episode. Also, while you're at it, sharing with a friend, you might as well tell them a perfect stock to buy because, of course, you know the information better than Sean's data that he has over on the app. Isn't that right, Sean?
That's right.
I'm just messing. Well, awesome, guys. I appreciate you as always for tuning in. And with that being said, I'll see you guys next week.